Resume the recording. Awesome. So thank you everybody for joining our massive capital, well, boy, I can talk. The Massive Masters Wednesday case study. We make things a big mouthful when we put things together. Super excited about having everybody here today. Today we have a treat. Sanjay is going to be doing our presentation today. We've got a bunch of folks here from the Massive Capital team. Super excited to have everybody here. Thank you so much for joining. We can go to the next slide. So to make sure that we know that this is for educational purposes only, everybody should seek their own legal, tax, anything to do, professional advice before you make any investments in anything. All right, next one. So we're super excited. You guys, if you haven't signed up yet, you're missing out. We have our virtual conference coming up this Friday. It is an all-day conference. We've got some amazing speakers. If anybody's heard James Ng from Old Capital, he's one of the ones that's starting us off. We have Rod Khleif, we have Brad Sumrock, we have Neil Bawa, the mad scientist. We have all of the mad folks already. We're all mad at Massive Capital anyways. So there'll be a whole bunch of folks. We've got brokers. We've got everything that you could learn in a day. You're going to need a supply of coffee next to your desk. It starts at 8, networking, and then we start all the presentation. It's a full day. I think we have the schedule, I think, is on the next page, Sanjay. Yep, so that gives you an idea. So we've got some networking in the morning, state of multifamily, and that's actually, we have James Ng is going to be doing that particular one from Old Capital. If anybody's not heard him present, he is amazing. The guy has a lot of information. So we've got a lot of things happening through the day. There's a link there that you can sign up. We hope to see you there because it's going to be a great day of learning. It's an entire day long. So I had a friend of mine who told me that Massive Capital gives away more information for free than he gets in his mentorship program he paid for. Our goal is to provide education. We think that educated folks are going to be more successful in their passive and active real estate investment. So hope to see you there. Oh, there's the speakers. They all popped up at the end. Okay. Some good looking guys there. We need to get some girls next year. So coming up this Saturday, next Saturday, pardon me, we have our third in the series of our masterminds, and it's going to be about asset management. Asset management is super, super important, and we're very excited. I've actually never been to Rice University, so we're actually holding it in Rice University, and even cooler, they have a bunch of the Rice University MBA students who are going to be joining us for this session. So it's super excited for us to be able to do one of our first partnerships with them. We've set it all up. It's a full day again. So get there bright and early in the morning. We have some coffee for everybody. We're going to be in breakout networking groups, and it goes all day long. Lunch is provided. Certainly hope to see you there. I'll pop a link in the chat in a minute. I forgot to pull that one up and save it. So we hope that we see you in Houston, Texas. For those of you in Dallas that are jealous, we're going to be running it starting in June. And then if you live somewhere else, I'm sorry, you're going to have to move to Texas. No, we're going to work on a virtual option. So.
Yep, we will.
And again, this is the structure for our masterclass agenda. It's a full day. David, who's been hired on with Massive Capitals, our full-time asset manager, will be there as well. So there's a lot of things happening. Anybody who thinks that when you close a deal, your work is done, you are wrong. When you close a deal, your work has just begun. And you've got 5 years of managing an asset, protecting your investors' money. So we're super excited for this one. We hope that you can join us. A little bit about that. Today, we're going to talk a little bit about Massive Capital, our value add to investors and partners. Today, we're talking about retail new development construction. We will always have time for Q&A at the end. For those of you that have joined late, don't worry. All of our sessions are uploaded on Massive Capital's YouTube channel. I will post a link here, but you can go back and see every one of our episodes, everything to do. We post a lot of content there. So please make sure that you check it out and subscribe. That way you get notified anytime we upload a new video. So Massive Capital is a vertically integrated real estate company specializing in ground up construction, retail, flex, industrial, mixed use, multifamily, and we are owner operator of value add multifamily assets. You can see we're pretty heavy Texas focused. We have a lot of assets in Texas, but we do have them in Denver, Colorado, Atlanta, and North Carolina. We have looked at a few deals in Tampa and Phoenix for the retail triple net lease locations. Nothing has happened to date, but we happen to have some strong partners in those markets, so we wanted to be able to do it. On the left-hand side, you see that Massive Capital is equity fund. We have a brokerage. The brokerage is for the triple net, and also the property management is for the triple net. For those that don't understand what that is what we're talking about tonight. It is retail types of locations where you manage it. It's not apartment complexes. We do a lot in the development, construction, and tech. So for those of you that have never seen some of our tech things, we have an amazing CRM. I'm going to put a link in the chat here. We're actually offering a 14-day free trial if you'd like to take a look at our tech solution. And then in the bottom, you'll see our company. So our sister company is Realty One. They'll also be at our virtual event. And they have about $290 million in assets. We're in partnership with them right now where we're doing a deal here in Austin. We're building a new retail. I went by not too long ago. And then Massive Capital itself has 203 million in assets and 1,387 units. We have the X-Base development in Houston. I don't know if they've started yet because of all of the rain, but hopefully they'll start any day now. So this is the team behind the team. So if you can see across the top of the folks that you'll be dealing with, maybe on a more regular basis, and then underneath that has everything to do with our asset management, acquisitions, all of our different directors of finance in the Realty One company. And then we have Ramesh, who's running our whole tech department. He's got some folks in there. We've got some financial analysis. And then the bottom folks are all of the managers for Realty One, just to make sure that if people understand, when we build something like a retail shopping center, our managers hire contractors and manage the contractors. And that is the most efficient way for us to be able to leverage everybody's skill sets. The team, the main team, the partners. So we have Shirar, who's actually up in New York City at the family office. We have Sanjay in the middle, who's going to be doing the presentation tonight. Mike has joined us remotely. He's up in visiting his parents up there up north. And then on the bottom, we have the Realty One team, Bo, Pat, and Alexis. And for those of you that don't know, 5.5 years ago, I made my first passive investment with Sanjay. So we've known each other for quite a while. He's been a part of my real estate journey, all of my real estate journey. So it's super exciting to always share the stage with him. All right, so Massive Capital closed 15 deals. We still have opportunity of horizon. We're getting close. We've got a couple more investors in today. So we've closed, but while we still are taking money to fund the CapEx. Our CapEx project is about an 18-month project. So we still had enough money to be able to close, but we need to complete it so that we can get all of the work done. And you can see here, we have one property under contract. We have several that are in the PSA negotiating. I think we're best in final on a couple of deals. So we're super excited about that. We need to get some deal flow going for this year. So always very excited. You can scan that code, get access to all of our deals. Always excited to be able to share our information with our investors. So massive value add group learning by actually doing. So we do have the massive mastermind. And our mastermind is designed very much different than everyone else's. It is a pathway to partnership. Our goal is that our students, our folks in our mastermind will actually become our partners. We've structured everything to where we do it in a group work environment. So there's calls every day, they review deals, they look at deals, they do lots of different things. Super, super important for us to be able to do it. Our goal is to find partners, and that's what we work on. And again, I think this one here, we don't need to do this one tonight. Sorry, I forgot, we forgot to pop it out. So this is what, oh, no, go back one more, there we go. So we do have an opportunity where folks can joint venture with us on land. So we're looking to develop. So if you have land that is in an A class type property position area, we would really like it to be able to partner with you. We're also looking for new acquisitions on multifamily properties. Oh, we went to out of the.
Sorry.
That's okay. We also have asset management advisory. So if you want to learn more about what we do, come to our event in Houston. And we're also at a debt loan guarantee. So it's our first time we're actually KP on a property in Texas. So we're very excited about being able to help a team be able to put their deal together. And then I think we have the last one there, which is our massive capital mastermind. And we have a lot, and I'll put a link in there where you can get some information about our mastermind as well. All right, you ready?
Yep, ready. Okay. Everybody can
All
hear me
yours.
okay? Okay, sounds good. Thank you, Trevor. And yeah, it's an honor to be, working with somebody who invested. Trevor was, back in 2016, 17, when I was doing some of my deals. He was one of the early investor. I have to say, Trevor is everywhere. He found the information and he was at the site and he was calling about the deal and questions. So it's great to have that active. So I mean, it's amazing how Shred is just everywhere. So yeah, so today we're going to talk a little bit about the new development, and then the retail development, and then I have a brief on the underwriting. Of course, we can go a whole day on underwriting stuff, but an underwriting tends to be such a like a mystery or a big deal. It is a big deal because a slight change or slight different assumption can mean big numbers. But to screen the deals, to understand the deals, keeping it simple, and being able to visualize what's happening is very important. So that's what I'm going to share here, is to kind of, anybody can pick up something and try to understand the deal given some basic information. So, but at Massive Capital, as we were talking, multifamily tends to be our main focus, existing multifamily, but why new construction? Why retail? Right? And one of the biggest reasons is diversification, right? Existing multifamily is existing multifamily. It's got its own risk. Got its own cycle. But as I hope everybody hears, diversification is the best advice that is given out there, the current thinking, and doesn't mean that within real estate you cannot diversify, right? So for us, what our view is that new construction of retail is one of the best way to diversify from multifamily because of the cycle that it operates, because of the type of cash flows and the risks that are there, right? So when we talk about diversification, what are we talking, right? Like, what are we diversifying? Again, returns is one of the biggest thing. So timing of returns is the thing that we're diversifying. So within the timing, within your return itself, it's the cash flow and the total return, right? So you may have a 50% return or 100% return on a deal, but if you get 20% every year consistently cash flow or 15% consistently every year, that may be very different risk, very different structure than getting the whole, 100% return after 5 years, right? So two deals that may have a same total return but different cash flow, or may have a similar cash flow but different total return, right? And that's what diversifies retail from, which we'll talk a little bit here, how that gets diversified. And the risk. Risk is a big part. Multifamily, we love multifamily because it's a basic need. It's the financing is backed by Fannie, Freddie, HUD, other agencies. So there's always some sort of a capital or money available. Whereas retail, while there is no agency and other government type of loans and financing available, the risks are different, right? It's a triple net lease. In most cases, a triple net lease is, so don't have to worry about the variability of a roof leaking or AC breaking down or plumbing issues. It's all tenant responsibility, right? So different type of risk on the retail. Once you get leased and get going, the time and is different. And then, of course, the total level of returns is there. So retail tends to be new development. Retail can be up there with some of the multifamily returns, but typically retail is higher on cash flow, but the total returns may be lower because you're getting your cash flow a lot sooner as opposed to later in the cycle. So that's where the level of returns tend to differ. And then, of course, everybody, individual as well as the family that does any investment, they have their own need and their own use of the funds. So, if somebody is later part of their life, then in their overall life, then they may prefer more cash return than the total return, right? The cash flow now, the total return. But if somebody is, relatively young and, they have a lot more time left to let the funds grow, then they may prefer the total return as opposed to the cash flow now, right? On top of that, the time, right? How much time somebody want to be involved, or the team, the location. If you go to a certain location, multifamily versus retail can be different, right? So a lot depends on that, and you will see, the chart. Um, I try to kind of put this chart together where x-axis is in a time and returns is on a y-axis horizon, which shows different type of assets. Where do those fall in the current cycle? And that's a key, current cycle, right? These cycles change, markets change, shift, the society needs. So of course, office is from a return perspective is at the bottom of the barrel, and it'll take a long time to get the return, right? So uh, that's why we hardly do any office. I know a lot of people are familiar with the family fix and flips and can relate to that. So I kind of wanted to put that on the chart as a comparison. Fix and flips, decent return, especially unless you're finding your own deals. If you're going through the channels of somebody bringing you the deals and you're the one putting together a deal, then the returns can be decent and fairly quick, right? You do the fix and then you sell it and you have the return. You're not really taking the market appreciation benefit. It's really paying you for the value add that you do. Then you get into the new development entitled, and I've differentiated new development entitled from a new development that is not entitled. So if there is a land development going on, those tends to be longer horizon project. Return tends to be higher because you're starting early. And in an entitled project, you cut the cycle out that it takes to go through the entitlement process, but and then you get the return. So you lose a little bit of a return, but get a little quicker on the entitled because and this entitled word gets floated around a lot. People use the word entitlement, land development, construction, paper lot, shovel ready, all kinds of words are used. But I always think the way I like to think is if I buy a piece of land and the next day I don't have the capability or permission to start the construction, it's not entitled to me. Entitled means everything is approved, it can start, the construction and development can start. So anyway, so retail tends to be a little bit higher return generally, and the cycle is you hold it a little bit longer. And then your existing multifamily is right there in the sweet spot. Again, everything on the y-axis, you can assume if it's got a higher return, it has some sort of a higher risk. So, existing multifamily tends to be a little bit higher risk than fix and flip just because it's a commercial versus a residential there. Um, the office is one of the lower return, but they are actually higher risk right now. So that's why the returns and risk are a little bit separate. And then when you compare the return versus risk, you always want to look at the your total portfolio. So whatever you are holding, the total risk combined with the return. For every type of asset class, there is some sort of a systematic risk. And what I mean by systematic risk is, there is a market risk, stuff can happen. Third World War can start, who knows when, but it can happen, right? Outside of mostly our individual controls, right? And then there are unsystematic risks. Some of those tends to be in our control, and we can do things and change things. So, total risk is combination of those. So, in your portfolio, you want to make sure that depending on where you are in your investment cycle, in your wherever you're doing, that's how we look at it. Again, this is not a financial advice, but that's how we look at it. And I'm okay to add a little risk because that would give me a higher return and potentially more time involved, but definitely helps on the total return. So always risk adjust your investment, multiple asset classes, multiple location, and continuously invest. So timing the market is one of the hardest, if not impossible. So as our massive capital, our philosophy is you do invest continuously. So in the good, in the bad, you underwrite it differently, but continue to invest, right? It doesn't mean you don't update underwriting and change how you evaluate deals, but continue to invest. And some of the questions to ask, we always go through this. What is the cost profit structure? How many deals are underwritten? Previous experience, and then of course, the fund itself, the investment hypothesis. So, okay, so now getting into the new construction workflow. So I just wanted to review this at a high level, why we like the new construction, and earlier what I was saying, the entitled project, right? So so there is a project inception where, there's an hypothesis that there is a piece of land and we can build multifamily there, or we can build retail, mixed use, industrial warehouse. So different option to build. And that investment hypothesis really kind of sets the scope, schedule, budget, pro forma. And based on these two things, you do some estimates, soft costs, the horizontal, vertical and financing is very project specific. What type of project it's going to be, multifamily versus retail, right? Very different financing. And based on these scoping, the estimates, the actual design happens, which is the type of construction, unit mix, building footprint, and what is the building type is going to be, and that gonna kind of gets fed into the approval. And once the full approval is there, that's where a project is. I consider this as entitled. That it's ready. As soon as city has given the approval, the cost, the financing is in the line of sight to the financing is there, and it's ready to hit the ground running. So once the entitlement is done, the actual construction starts. So financing, labor cost, material, and once construction is completed, lease up, so property management, pro forma, and then eventually exit based on the micro economy, what's going on, what is the right time to exit. And I have a red star here because the Harris Ridge project example, which is fully funded, by the way, construction is underway now. We started and got that project fully entitled at this stage. So once we closed, the land transfer happened within 2 weeks. The bulldozers, the excavators were on site digging and doing the grading process. So that's where we started that project, and that's the example we will go through. For a lot of the new construction, a team should have the project know-how. You don't know what you don't know, and as you evolve, things hit. So really, really important. There is no replacement for the project know-how. So the process and the project know-how. Of course, for financing, the net worth is needed, liquidity is needed. Both of those. Without that, financing not there. And of course, there has to be some risk capital in case things don't work out, they go a different way or as planned. So once you have this process, it's you're going through the process. How do you assess? What do you say from an underwriting perspective? Evaluate a process, right? So I have a little screenshot of one of our templates. This template, believe it or not, we use it both for multifamily and retail new construction evaluation. In new construction, upfront, while you're going through this stage, city approval, over here, this is a very simple generic flow, but in reality, there is a lot of back and forth happens here, right? You submit your design, and city council looks at it and says, well, we have this requirement, we'd like you to do this. This is our plan for the city. We want to do this direction. So feedback goes back, and then it changes, then estimate changes. So there's a lot of back and forth happens for this. But once it's entitled, the number of units, all the blue cells here, number of units, unit average square foot, retail square foot is set, right? Exactly once city approval is there that how many number of units, what is the average square foot is going to be, and what is the total retail square foot building is going to be. So and really, like for our purposes, we do napkin underwriting for land that hasn't quite gone through the full process. But we have engineers and architects who will do an initial assessment, and they will tell you, they can tell us that, hey, based on the setbacks requirement for that area, based on the utility easements, the building setback, the utility easements, based on grading, simple grading maps that are available, we think total building footprint can be 20,000 square foot. And then if you do 4-story, you can fit so many units at average size of that for each floor. And then the retail square foot can be there. So really estimating those numbers we kind of use the construction cost of $184 per square foot, which determines the cost to build. Land cost, whatever the land price is to purchase, gets punched in here. Development and overhead is just a percentage, which we do change depending on the type of projects and what we're doing. So it's calculates automatically, and it gives a total project size, right? So based on the total unit, total multifamily square foot, total retail square foot, total construction cost is calculated, which is the total construction, and then the land and the development overhead. Development and overhead can be a pretty significant number. If it's a 20 million project size total, if the loan is around 14, 15 million, it can take 1 to 2 years to get through this, and at a 7, 8, 9% interest rate, just the interest paid over the first year, 1.5 year, can be in millions, right? So development overhead is a significant amount to plan and budget it up front. So key part of the napkin underwriting. But all of these three combined gives the total project cost. And then, on the right-hand side, based on the number of units that are built and the average rents, that's the kind of the comps for that area. The retail, the similar thing, what the retail could be leased for, gives the total rent. And then, depending on the market, depending on the location, and depending on the type of buildings these are, we put an assumption for an expense ratio. So, a typical suburban Dallas, suburban Houston, brand new build, we start with the 40%, and retail, it'll be a triple net type of a setup. So maybe a 5 to 10% expense ratio. But, this can be significantly lower given the type of construction or the location it might be. And, this can be slightly higher if there are a lot more common areas in the retail versus all the stores. And based on the expense ratio gives the NOI, and assuming a cap rate, it gives a project value after all said and done. And then this value of the project gets compared to the total project. And as long as we have a good ratio of profit over this, this is a good project to for us to take on and look further and evaluate. And of course, once we have more solid estimates, a detailed underwriting that gets done, of course, the lender is going to require that. So that goes into the detailed underwriting. So with that, I have the example of the Harris Ridge here. This is the north of Austin. On the north side of Austin, there's the address, a total of 16,800 square foot with a target rent in that range. 30% of the building is already pre-leased. Triple net, which is on top of the rent, is there. And then I have to build in some tenant improvement, which is negotiable. And then it shows the preliminary building footprint, and the building elevations done by the architects, and the corresponding parking around it that needs to be there. And one of the reasons we liked the project, and you will see, it's a 20% plus IRR, and it's within a 3 year, it's almost a 72, three-fourths of your capital being a multiple on your capital. So and there's a locked-in preferred rate, but we love the retail because it completely changes the risk profile for overall portfolio. So and I should highlight that this type of construction, it's a neighborhood retail as opposed to a anchor retail that would have one big store, a Walmart or or a big grocery chain or something like that. Um, and we see those retail stores, retail development as a little more risky, just because that one client goes away or changes their business plan, then you have to budget, you have to plan for that. But these type of stores are, you get a small business, as long as business does well, they are there, for years. If one tenant moves out, you have still the other tenants, and you can look back to lease that. So these neighborhood retail stores are evergreen. Even during the COVID, when a lot of the stores were shut down, a lot of the neighborhood stores were still opening up, or one of the earlier one to open, because residential neighborhoods around those retail stores still needed those services, right? So anyway, so we like that from a risk profile perspective. And it has the triple net component, right? So that's a cash flow that's there, that's coming in regularly once you get this leased up, and it's there. So we like that. And for this one, again, the location is everything for every project. Location, 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 right? So this project was located at a great location north of Austin, with a lot of employers in the area, and job market and growth. And Austin tends to be a little volatile, with the recent Tesla and other couple layoffs. But from a long-term perspective, it's still a solid market. Solid. They have a growth from a tech side, and various other businesses that have plans to move and get there. So that's the prepared material that I have here. Trevor, did you want to add anything else for
So
the?
we did have one question. What is systematic versus unsystematic risk again?
Okay, let me go back. Yeah.
Yeah.
Good question. So systematic risk is like whatever system you are operating in, it has some inherent risks. And then there can be other risks that are not systematic. So for example, if you are in real estate, you have the interest rate risk, right? That's a systematic risk for real estate. Whereas if you were to go invest in just taking an example, a utility company, which is a commodity, very little variation on interest rate for anything to do for a utility company, right? Uh, research and development is a big deal for them. But for real estate, interest rate is a big systematic risk. Outside of that, how do you operate that real estate is an unsystematic risk, because you can control that, you can change that. That's not a potentially a risk that is uncontrolled or outside of your control. Taxes. So for Texas markets, real estate taxes are high, right? Whereas you go to other markets, North Carolina, Denver, Colorado markets, lower real estate tax. So real estate taxes is not a systematic risk for those markets, because those taxes are lower. We pay 15 cents on the dollar just in real estate taxes from our income that we generate, the rental income. So that's kind of the difference. Does that clarify? I see there's another question. What is a triple net lease? A triple net lease is a lease agreement on a property where
Yeah, I just posted that in. Exactly what is it, just to clarify it.
Okay, yeah, and if anybody needs more clarification, let us know. Yeah, please, okay, there's another question. What is this DSCR? How did you calculate this and its application in your calculation here? Okay, so DSCR is a debt service coverage ratio, which is usually the requirement for the lender. We have here that for us, this ratio here, which on the example, this is just a template, it doesn't show up here, but once we fill some numbers, we want to see the value of the property after all done to be at least 50% higher. So for example, if the total project cost is 10 million, I'd like to see a resale price value of the project at around 15 million. So if we are in a market where the cap rate is more like a 5, then I want to see 15 million on this. If we are, so retail tends to be a little bit higher cap rate, so maybe 6.5, 7 for primary markets, maybe 7.5, 8 for secondary markets. Then if the project size is 10 million, I would want to see 15 million on this number here. And that's what we kind of refer to that here.
So there's another question here too about anchor tenants. So there are different types of development. So right now, again, we've talking a lot about what we're going to call the local retail. That's what we're building here in Austin. We're looking at a few other sites, and that's where it's a series of 5 to 8, let's say, small shops that cater to a neighborhood. Definitely when you go into a lifestyle development, so through Realty One and our partners, we have several lifestyle type developments. And on lifestyle developments, they definitely will have some anchors. So for example, the one that we all visited in Houston when our team was there was a grocery store anchor, but they also had offices and some multifamily built on it and a series of restaurants. So it quite differences a little bit. So, but on the lifestyle centers, you definitely need some sort of anchor tenant. And normally what happens, especially on that development, the high expensive retail, similar to what we're talking to tonight, usually goes in the front of the space, the closest to the road. And then behind it goes the larger anchor, perhaps offices with multifamily above. And even the one we looked at had a third element behind it, which was industrial work retail. So where you had an office in the front and a garage door in the back. And so you could meet clients in the front, you could deliver things in the back. So there's a way to mix up anything. And a lot has to do with what the neighborhood needs and what is available. So we're looking at all of those types of developments right now. But we're just using this one as an example. Hopefully that helps answer. And there is a huge difference, obviously, on big box retail shopping centers. Those ones, although I went to get a suit for my daughter's wedding last year, and I was surprised how busy they were because I hadn't been back in a while. They're definitely struggling more than if I go to my neighborhood retail center here. I gotta wait. I gotta wait to get in to get my lunch, and sometimes I go pick up my pizza, and I have to park 3 stores away to pick up my pizza because they're super busy, very successful. Because a lot of people are staying more in their neighborhoods because they're not traveling to the office anymore, so they've become much more neighborhood reliant.
Yeah, and kind of going back to that, one of the questions there is, wouldn't anchor retail be more stable than neighborhood retail due to potential of that tenant having longer lease and potential higher rent? So, while you have that anchor tenant, it's potentially you have stable cash flow, right? But whenever that tenant moves out or anything changes, you have a huge dip in your cash flow. And when you have that huge dip, since these are triple net leases, meaning tenant pays for taxes, insurance, common area maintenance, repairs, etc., when that tenant moves out, not only you don't have the revenue, you got to pay for taxes, insurance for that space, and any maintenance and all that. So risk is defined as the volatility. The more the difference between the highs and the lows, the higher the risk, the more volatility. So with the anchor store, you will have more highs and lows, and that's what makes it high risk to me, because um, when the tenant moves out, and God forbid for 3 years you don't find a bigger tenant, did you have enough cash stashed away to cover all the expenses or not, right? And then if you stash away the cash for that one scenario for, let's say, 10 years, well, that cash is just sitting on the side idle, not doing anything, right? Yeah, you can put it in a high savings interest rate or something, 4 or 5%, but then the opportunity cost of that same cash is 20%. So on these, you don't have to keep as much cash. When tenant moves out, well, it's a smaller business, you can quickly find one. So the time between new lease is not that long, and you're just chipping away on a small portion, so your variation of the cash required is not that huge. So
Yeah,
that's
that's awesome. And Mark had a great question, the difference between the types of returns. So let me do a little explanation. So on the far left, we have our internal rate of return. Internal rate of return is really the time use of your money. How long do we have your money and how much did we give it back? And then there's the minimum investment. And then the total return is an estimate if you gave us $100,000, let's say, to make my math easy. At the end of the 3-year period, we're going to give you $172,000 back. The preferred return is what I call a safety net for passive investors. So what we've said is until you make 7% return on your money, us as the sponsors, we don't make any money. So it's an investor first approach where you get the first amount of cash that happens. Then after we've satisfied the 7% return, you'll see in the very last chart, we have a split. So we've said 70-30 is the split, but if we achieve more than a 17% IRR, which we've estimated we will, it's a 50-50 split. So again, what happens is we have an investment vehicle, we give it the first set of the returns of the cash flow to our partners. If we do very well, as a sponsorship team, we do very well. So you want to get on average more than 17% IRR if at all possible, but that's a real win-win. It super is a win-win. So again, the type of returns, again, we're talking about this, want to make sure I'm clear. These types of return investments normally don't have any cash flow, right? You spend a year or two building it, then you take it, put it through, and then all of the money really, the third year, there's a little bit of cash flow, and then there's the sale event when the money is split up. So there's quite a bit different. Retail, this type of new development is a different structure than, let's say, our multifamily. And then we have a question here. I'm not quite sure on new buildings in this market, which year, second, third, or fourth, do you expect return payments for our investors? So again, on this particular deal, it was build it, lease it, sell it. That's how this particular deal was structured. So the investors are going to get out within the 3-year period. And on year 3, there were some payments because we're generating some cash flow. So you always want to share the cash flow as quick as possible. Hopefully that makes sense.
Yeah, and yeah, so really we're drawing from the construction loan to build the building. There's really no income. Even when the first tenants start to move in, the cost of capital is very expensive, right? So it's better to use less from the construction loan or whatever the capital than starting to distribute early because it's really taking from one pocket versus the other. So typically on the new build, unless it's a buy and hold, build and hold, the cash flow is not until the building is complete. If it's an entitled project like this one, we expect to finish the construction in 18 to 24 months, if not slightly sooner. And then, if you hold it, then there is a cash flow for that.
And triple net on the second question is very normal in these types of businesses. Not always. I'm a passive investor on a retail center up in Plano, and they did not have triple net in place on it. And one of the value adds was to when any new tenants came in, to put them in a triple net situation. So a triple net situation takes risk off of investors and puts it on tenants. And then I'm actually a passive investor on a medical center that's a double guaranteed triple net. So the doctor personally guaranteed and his practice guarantees the lease. So again, if you want to get to the next level, it's a double guaranteed triple net lease. So the guy not only has to go bankrupt, he has to lose his practice if he's going to get out of his lease other than when it expires. So again, the safer the investment, often the lower the return. So that particular medical investment, I'm only getting a 10% cash on cash return, but I'm quite happy with that because again, you want to have some investments that are safe and some that have an opportunity of bigger returns. That's how you balance out your portfolio.
Yeah, and to that point, your point, Trevor, the follow up on the same question, is triple net the norm for current investment in these markets for minimizing overall investment risk? Or what is the reason for going triple net? So, that's where we started, is the diversification is the reason for, having some triple net in the portfolio, some multifamily, and some, new development type of investments. And that's the reason we are doing and going into some triple net. We would go do that in any market, not now versus before. It's really not a timing. It's just portfolio is better in my opinion.
Awesome.
Okay,
So
and
we'll
then
just talk a little bit about our massive capital masters here at the end. I'm also going to launch a quick little poll. I forgot to announce the first one I did, but I got 60% people in doing it. So super happy to get that. So we do have a massive mastermind program that you can join. So called the Massive Masters. And if you want to pop through. So on the left-hand side, we have a fund manager, capital allocator. So this has all to do about raising investments, raising capital for real estate deals. And then on the middle, it's a deal sponsor. It's actually where you become a partner with Massive Capital. So you get everything in the first category. And then we do a lot of deal room access, deal evaluation, all the lender broker relationships. So the goal of our mastermind is very different than many other massive minds. We are looking for people to be partners with us. We are looking for folks to be able to do deals with us, take us to the next level. I refer to it as the mastermind group is the tide. And as we get more folks into the tide, it raises the Massive Capital ship and we can take on bigger deals and do more things. And our goal is to do it as a team. So we have a community of everybody. So we've done, lots and lots of different things. Massive Capital, again, 15 deals. We've raised $44 million. We have over $200 million in assets. Our team has calls every single day. And so you're part of a community. We have training and education, so a live deal room. We have a live WhatsApp chat, all types of things that happen. Every day, Sanjay and Shrar and Mike are on calls with our team, and they are analyzing, underwriting, making offers. Just to give you an example, last year we underwrote 600 deals, made 60 offers, and got 6 deals. So a lot of activity, but our team does everything with us. And we'll pop to the next chart. A lot of tools. So we have all different types of tools and everything that's provided. We have all kinds of meetups and things that happen. And then on the next one, a lot of marketing events, live engagements, guest speakers. And at the end, we have our CRM, Massive Capital marketing, all types of different things. So the program offers quite a bit. I'm going to stick a link here for folks to be able to get some information. And you can also scan that QR code. And if you have time, take the survey, let us know. So someone asked me directly, what motivates a tenant to get a triple net lease? The fact that there are no other leases. It's not like there's options. That is what all of that business has been set up. Offices also set up that way. A lot of those types of businesses are set up that way. to where it does. So, well, they had to leave and they're in California. We don't do much in California. We would consider maybe some retail, but California is a tough market.
Yeah, so
Awesome.
California development, we just don't have experience. We have just not set up for that. So we will avoid that for now. We're mostly focused on the growth markets. One of the first slide we talked about where we are, what markets we are looking at.
And if you're interested in learning more about capital raising, we have a call on the 2nd and 4th Tuesday. So tomorrow at 12 noon, you can join this particular. It's more of an interview format, but it's super, super great place to be. We have Alex Lovely, who's been a friend and associated with Massive Capital for a long time. He's going to be talking a lot about how he built his social media presence. He's got quite a big following.
Good, right on the dot, 7 o'clock. We'll hang out for a little bit. If anybody have questions, we'll stop the recording and then ask anything away after that.
So there's a
Sanjay.
question in the, go ahead, Shar. Nice to see you.
Hey, thank you, man. We have, from the new construction perspective, just wanted to share that we have GC licenses in Florida, Arizona, Colorado, and Texas. So we own the GC licenses. We have done projects there. We means the Realty One team, and right now all the large projects are coming through mostly in Texas. And the majority of the projects that we're looking at right now to underwrite or pushing to do, we are JVing with the landowners at this point. Landowners are coming in. The land as an equity, we are rolling that into the project. We are using our banking relationship and our balance sheet to take the loan. We're doing the construction and the lease up. So it becomes a white glove service for landowners. We're not actively quite looking to buy land right away. The reason behind it is if you have to buy the land, then cost of capital is high. So land price has to go in. So we're recommending the landowner to stay with us so we can pay more. That's one. And the second thing on the new construction is mostly Class A. It's like a Class A will be, median income if in Houston, it's pushing 6 figures, $120,000 there. And if we're in Austin, then 120 to 150. If in DFW, it's around 120 to 150 as well. And that's the definition that we use for Class A location. Back to you.
Awesome, thank you. And there's a question in the Q&A about rewriting a lease with existing tenants. That's very challenging. I mean, a lease is a lease. It's a binding contractual agreement. So again, sometimes you're saying, so for example, on the deal, I'm a passive investor in Plano. During COVID, a lot of the businesses struggled. So they went back to them and said, we will do some rent forgiveness if you will re-sign a new lease. And again, during COVID, a lot of folks were just trying to save their businesses, keep going. The one restaurant didn't make it, but and oddly enough, the only tenant that thrived was the liquor store, and he did so well, he moved to a newer shopping center and ended up giving us a vacancy. But it happens, and folks are, it's just the name of the game of what you're going to do. And now they can't do crazy improvements and just charge it to the tenants, right? There's all kinds of rules and regulations in your lease of what they can do and what they can pass on. So we're up to 33% on our survey. So if you get a chance, please fill it. We're going to stop the recording, which means you can ask us anything and it won't be on